Good afternoon. This is Brad Olson with Oak Tree Financial Services. I'd like to thank everyone for joining us. I know we have a nice crowd that I see have signed into the webinar. I just wanted to spend a few minutes, around 30 minutes, just highlighting a little bit about what's going on with the economy. I know right now that a lot of people are very concerned, which rightfully so. As I always tell people as we're having our meetings, we never take market adjustments lightly. We never take seeing accounts change in value lightly. It's something, though, that we want to use logic, not let emotion drive every decision that we make, which is very important. I'm going to go through some of these things fairly quickly. If you have any questions, please, we have a Q&A on your Zoom meeting login. You can see there, you can feel free to submit questions. I will take those questions at the end. Some of the information, like I said, I'm going to go through quickly. If you want further follow-up, feel free to let me know and we can go into more detail on certain slides or certain ideas. So feel free to submit the Q&A. First of all, I want to start just a little brief on the agenda, a little market overview, knowing when you need your money, business cycle and why it matters, fine-tuning your portfolio, election season emotions. We must control those. Emotion and analysis, market logic, talk a little bit about that, and feel free to ask questions. First of all, I did want to start probably the most important thing that I make sure that I cover with each client. And if we haven't covered it in detail or if something's changed, please let me know. As far as when you need your money. And that to me is a very important item. The first thing that I'm going to talk about a little bit is what I call the bucket approach. And really the concept here is when we have these market downturns, we want to make sure that we have a right amount of money set aside. So when you need money, that we have that available and we don't have to sell things when they're down. That is very, very important as we go forward as far as addressing the overall approach to investing. This is not something that's unique to us. This should be done with every person when they're making their investments. Now, I classified this into three different categories. First of all, when you look, we have your, what I call your liquid investments. So those are basically emergency money, 3 to 6 months of income, 3 to 6 months of expenses, or even a little bit more set aside. Major planned expenses, anything that you have, for example, that you're going to need to take out. For example, and I put here in the next 3 years, definitely in the next 1 year, medical, travel, renovations, vehicle. We need to make sure that we have that money set aside if you need it. And also income. If you're taking income from your account, we need to account for that. Why do I call this liquid investments? These are areas where we need to make sure that if we liquidate these investments, they're not going to be dramatically affected by where the market is at the time. Same thing with the semi-liquid investments. When we look at those, that is basically, I kind of classify this many times into that income you need. I like to set aside anywhere from 3 to 5 years of income. So I'm accounting for that. So if you're taking out $50,000 a year in income out of your portfolio, then we want to make sure we're accounting for around $150,000 or so, depending on how conservative we want to be. And also depending on where we're at in the business cycle, on what we're thinking about investment opportunities of having that money set aside. Now, once we get through these two, the liquid and the semi-liquid, then we get into really what we call long-term growth. And that really is the area where, as we work through the business cycles, we have time to work through those cycles. And we're going to talk a little bit about that today. This is a very important slide that we have, a very important part of our presentation that we want you to think about. So that's number one. I wanted to make sure that we're talking about that. The second thing is we'll take a little brief look at the markets. You can see it's been fairly volatile for a while. I mean, we had our peak back here in January 3rd of 22. We've come down and we've seen that we've erased quite a bit of the gain that we have. You can see now, again, many times we're using the S&P 500 index as an indicator. Again, there's no magic to that. It's 500 stocks, but I do want to, it's a baseline that we can look at. You can use the Dow, you can talk about the NASDAQ. There's a lot of different indicators that you can look at. I'm using the S&P as kind of a framework here. Now, some of these things, though, that you do see here, you can see, for example, here, it shows what the 10-year Treasury has done. You mean we went down to 1.6, we're up to about 3.7 now, and actually even higher than that as of today. So when we look, we have seen the Treasury yields go up. Dividend yields of the S&P 500, we've seen they've cratered a little bit, and they've actually come back quite a bit on the dividend side. Also, one of the things I'm going to talk about during this talk is talking about price to earnings ratios. Now, when you look at price to earnings ratios, it's a relatively simple concept, the price of the stock to the earnings of the company. So you take a look at what you're anticipating or what the current earnings are, it gives you a ratio. So if earnings are X, how many times is the price of the stock compared to that, all the outstanding stock? Now, historically, there's no magic to this. Again, there's no right or wrong. The bottom line, though, when you get up, for example, when we were here, we were at a 25. That's a very high price to the earnings of the company. Because when you get right down to it, two things are going to, that we've always focused on very simplistically, if you want to break it down, are indicate how we're going to do in the stock market to a degree. One is basically look at earnings of companies. Are companies making money? And second is where are the interest rates? And interest rates give us an idea of where the Fed is at and where we're at in the business cycle. Very simplistic, but it's kind of a baseline that's been talked about for decades in our business. Now, the good news is we have seen our PE ratios come down. The bad news is they've come down because prices have come down. What gives us an opportunity then going forward is the probability of them increasing again and coming up. So, but the question is, when is that's going to be? So it has been a very rocky road on a year-to-date basis. When I look at some of the numbers behind the scenes, I mean, you can see on a year-to-date basis on the S&P, we're down, in a neighborhood of 22% probably as of the writing of this. My numbers are as of last Friday. So when you look at it, we have seen a decrease in the S&P. Now, the good news is we did see an increase. So again, if you baseline this, we do look at going up and down, and again, depending on the day, we're not back to where we were in, back in the 90s. We're not back to where we were in 2007 and 2008, but we have erased some of the gain in the S&P 500. The key is, and one of the things you'll hear me talk about during this presentation, if we're in good things, you don't want to get out of those. If you're in things that are more marginal, we have been looking at those and seeing what we want to take a look at, what's going to come back faster. But one of the things we will practice on an ongoing basis, this is not a situation where you go all in or all out, because that is a very dangerous game that you play, because if you miss the upturns, you've locked in your losses for a long period of time. Next, I want to talk about inflation. This is an area that when we look at inflation, we've seen that it is a major part of what is happening to our economy. Now, there's many reasons why we have inflation. There is a feeling, I think the general consensus is we put so much money into the economy so quick that what it did is it did fuel a supply-demand ratio. So you had supply was down due to the pandemic, demand was up, drive prices up. We kept pouring cash into the system. Money supply was very high. It did fuel inflation. Now, the good news is we are starting to see that what the Fed did with raising interest rates and actually taking some money off the table by not buying as much and putting money out into the formula. What it did do is it did starting to see inflation come down to a degree. So that is important. Now, one of the things that we do need to see too is we are starting to see a little even thaw in this part, which I'll talk about in a second. So the good news is we do seem to have peaked with inflation, and that does seem to be a consensus. I mean, everything I've read basically states that. Now, the problem is it's still pretty high. I mean, you can say it's on its way down, but the question is how quickly will we get that under control? And until we do, the Fed has been very hawkish on their view on the interest rates. So when we look at it, when we're looking at inflation, basically we're seeing that inflation is finally declining. I looked at a couple of different inflation-based things. When I looked at, for example, I looked at commodities up here. I looked at PPI for commodities. Now, the reason I picked on commodities here is taking a look at what's going into production. What is driving the cost of making a good up? Now, we have seen that we've seen a pullback on these. So that's good. So we have seen that come down. That's a positive that we've seen. Consumer price index for all urban consumers. We have seen that that's leveled off. So the good news is when we look at our core CPI, we are starting to see that there's good news there. So what the Fed is doing now, again, I think we can all talk about the Fed being late to the game, where they should have addressed this quicker. First of all, probably didn't need the second stimulus coming out of the pandemic. Second of all, we probably were late in the game on raising interest rates, and that did cause inflation. Water under the dam, we have to move forward. We can't sit and complain about that. Hope we learn about it going forward. It may decline this. Now, the question was, when we look at inflation, will inflation basically decline as fast as it came up? Now, I did want to put this out just to give you an idea. This gives us an idea of what makes up inflation. Now, one thing I did want to highlight, you look at energy, we have seen that energy has started to pull back a little bit as far as its effect on inflation. Now, again, we're going into the heating season and some of those things, but overall, that's been a positive. You can see, but one thing that is a negative is we are seeing the cost of shelter housing is taking a bigger bite out of inflation. So when we see that, we're starting to see that the cost of housing, whether it be rental or buying, is going up. So that is inflating somewhat. Now, plus with rising interest rates, we've seen the mortgage market start to slow down a little bit. What will that do to the overall growth of our economy? Now, I also want to look a little bit at the yield curve. Now, the reason I bring this up, why I think this is an important item to look at, when I look at the yield curve, when the yield curve starts to steepen, when you're looking at this graph, the yield curve is still inverted, which means we're seeing the shorter term rates higher than the longer term rates. That's what an inverted yield curve is. In the past, what we've seen is it's hard for the market to gain a lot when we see an inverted yield curve. I mean, it's very, very tough when you look at that. So when we're looking at this overall, what we'd like to see is, and this is what will happen when the Fed starts being less hawkish on interest rates, we will start to see some of these things come down. When you look in that 10-year range, for example, we start to see the shorter term rates come down. Now, the good news is, and one of the things that I want to forget when I'm talking to clients right now, is we are starting to use treasuries. For example, I've been buying some treasuries in some accounts now. If we're sitting on cash, or there's things we may want to back off on a little bit and keep some money in cash, that what we're doing is we are using, for example, a 1-year treasury that I bought one this morning at 4.1%. So it's a way that we can sit on cash in a fairly attractive rate. But this inverted yield curve is something that we do have to watch as we go forward. So it is something that we want to see that change. And I think that will be a good indicator. Now, that will change when the Fed starts softening a little bit on the interest rate rises. Next, we want to talk about the business cycle. And again, if you've ever listened to anything I've talked about, this is kind of the essence of everything that I base managing money on, because it gives me a factual base to work off of. Now, what is the business cycle? The business cycle is basically indicated by what's happening with the economy. And we have leading, lagging, and coincident indicators. All these numbers I'm talking about fit into those categories. Now, what happens is when you look at where we're at, and I put some prior times on here, January of 22, June of 22, we've seen the contraction. Now, as we've come down, we currently have us in phase 4. Now, phase 4 is slowing. Phase 4 is seeing inflation peak, inflation start to come down, interest rates peak, interest rates start to come down. Now, what happens though, and one of the keys with this is you have to remember, you don't buy stocks, or you're not waiting for the recovery of stocks when everything feels fantastic. By the time the economy seems like it's roaring and everybody's happy, everybody's working, unemployment's at a great rate. I mean, we saw this before. What happens is by that time, you've seen stocks appreciate. Because remember, you're not buying a stock for where it's at today. You're buying a stock for where it's going to be down the road. So when we look, this is what I call the growth cycle. So this is when you start looking at getting back into things that have been beat up. So what happens is now during this phase, what we try to do is we have tried to look at things that are going to hold up better in a declining market. Dividend payers, sectors that do better than others as times are going down. So when you look at this, this is one of the things that we highlight overall is where we're at in the business cycle. But a key is you're not going to just start buying when things are here. So when it gets here, is, oh, things are sounding good, things are great, it's expanding. That's not when you start buying, because that time you've missed a ton of the appreciation. That's why we don't market time. Because what happens if you're trying to market time and you miss this, because this could be a lot shorter. Pandemic's a great example. If you tried market timing during the pandemic and you were out because you were waiting for the pandemic to disappear, you missed a ton of the upturn. That could happen again. Now, we think that it's going to be a much longer battle, but it is something we look at. So that's the business cycle. I'm going to go through some of these things fairly quickly. One thing I do want you to remember, and this is not being trite in my statement here, bad news is good news. Right now, when you're looking at it, for example, with retail sales, I mean, it's bad news. Retail sales after inflation rose a mere 0.9% year over year. Industrial output, meanwhile, is still humming, which is good. That is a good thing. The outcome, though, is we keep producing. If we start not using as much, we will see inventories go up. But this is actually not a bad thing, because that means we are starting to come under control a little bit as far as what we're buying. And that's one of the goals. When you're looking at things like inventories, as I mentioned, we're starting to see, for example, that sales growth is starting to come down and inventories were still growing. So what happens is you start seeing inventories accumulate. So when you look at the red line, you start seeing some of these things. So when you look at inventories, but the good news is we are starting to see some of that decrease, which means it is going to be a weaker economy, but it will help lower inflation. And actually what this does too is it starts making bonds more attractive, which we've seen. Revolving credit, I did want to highlight this is, again, what we want. I mean, it's not a great thing from a standpoint of what you want for a long period of time, but we are seeing that personal savings rates have come down, and we have seen that consumer credit is going up. Now, why is that? People have less money. I mean, we did infuse a ton of cash into people's pockets, and so they did continue to buy. Now, the situation, what we're hoping to see here is and that's beckoning back to the previous slides, we are hoping to see their buying habits decrease. Because if they keep buying, we don't want this to get too out of control. Then we see defaults, and that can be a scary proposition too. You can see back here during the pandemic, our savings rate was way up because we couldn't do anything. So there is a balance between these two, but we just want to make sure that this doesn't get too out of control. And it is increasing because people are putting more on credit. Consumer confidence, right now, not good. Now, the good news is today, for example, we just did have some consumer confidence numbers, because basically what we're seeing is we have seen a loss in purchasing power by the consumer. They don't have as much money. They don't have as much money to buy things. So what's happening is it means that the economy has weakened. Our economy, meanwhile, we're seeing inventory corrections. So basically what happens when you start seeing consumer confidence come down, people aren't feeling as good. Now, some numbers came out today, and when I looked at those numbers, they just came out this morning, that we actually saw a second month of seeing consumer confidence get better. So, and again, you're saying, why is that? Things are still bad. Well, in relative terms, it's good to see those trend lines go up. So when I looked at it, I saw that their consumer confidence has increased a little bit. Also, their expectations have increased somewhat. So that is good because it was getting very, very low. So that's a positive. So what the Fed is doing, bottoming us out, bringing us back. The problem is, again, it's a situation where with the patient, you got to be cautious. You want a lot of medicine to make us feel better, but honestly, you don't want to make us go into a coma. And that's where the Fed has a balancing act to do. So when we see consumer confidence, we have seen that get a little bit better just recently. Now, I did want to highlight this, and it's a very busy slide, and I'm just going to give a quick comment on the statement. But basically, when you see consumer confidence get to bottoms, you've always seen the market bounce back. Now, the question is when is our consumer confidence at a bottom? Now, you could say we've hit that. I mean, again, I'm not saying that for sure, but we could see that, again, because market timing is very dangerous. We're not going to outsmart the market. But what we have seen when investors feel the gloomiest is usually when things start picking up. And you can see what that's done in the past when we've hit some of these bottoms, what we can see with increases coming out of those. So that the question is, will we see that again coming out of here relatively soon? I'll go to a punchline fairly early here. One of my key points is, I think until you start seeing the Fed slow down on the interest rate increases, it's going to be tough to see that dramatically change. But the good news is the pain has been pretty bad, and we are starting to see some of that behind the numbers change. Now, I want to talk a little bit about portfolios and what we're doing. First of all, I always want you to understand, we do practice asset allocation. Now, it's a very basic term in our business. It just means you don't put all your eggs in one basket. As I always tell people, I remember I was doing a thing for my daughter a long time ago when she was in high school, and we were talking about, she said, well, why don't you just pick the colors up here that are the best? I mean, this is the time, these are the ones that are doing the best right here. Why don't you just go those? We don't know how that's going to work. But you will see, for example, if I pick on, small caps, which are this orange, you can see how they go up and down, up and down. It's the nature of small caps. Sometimes they're going to be fantastic. Sometimes they're not, because they're the most volatile stock due to the fact that these companies aren't as established. They can't weather storms as big as some of the bigger companies can. So our goal here is to use asset allocation as a base, but then use the business cycle to try to emphasize sectors that we feel will do the best where we're at in the business cycle. That's the whole concept of asset allocation. I believe there's a difference between stagnant asset allocation, where you just say, I'm going to be 60-40 for the rest of my life, I'm never going to change, and adjusting that accordingly to where you're at in your life cycle and where the business cycle is. Those are the two things that are going to dictate, but always keeping a base, not being in or all out. It's a very dangerous game to play. And to be honest, nobody plays it very well. I mean, you can go to people who supposedly have a lot of expertise in this business, the so-called quote experts, and you'll see that they really don't do a very good job of practicing market timing. It's a very, very tough game to win. That's why you practice asset allocation. Again, part of that is that over the period of time, what we've seen is we use the rationale of, you don't see as much, 1 year, if you're just investing for a year, the volatility of just being in all stocks can be dramatic. This is the volatility range you've seen on 1 year investments historically. Now, if you're a all bond portfolio, that's not quite as much. Your downside isn't as much. And if you're a 50-50 portfolio, you can see on a 1 year basis, this is the range that we've seen. You get to a 5 year rolling average and you're all stocks, you can see 28 in the up, 3 and down. Again, 5 year rolling averages going back. This is from 1950 to 2021, if I remember correctly. And then what we see is we look at on the asset allocation side, we've been okay. 10 year and 20 year, you can see it gets much, if you can invest for 20 years. Now, what I don't like is in our business, a lot of people will quote this, everyone's time horizon is not 20 years. That's why we go back to that bucket idea. I need to know, however you're investing, you need to know, we need to know what money we need when, because that is so important. Because we can write out business cycles and, even on a 5 year basis, it makes it so our probability of doing well, and again, tweaking the investments we're in and adjusting to certain sectors and certain industries will make a difference. But that's the concept behind time diversification, helping with those volatility of returns. Now, next, I did want to highlight one of the things that you will see. Remember when I mentioned about getting back into things? You will see this is a value versus growth type of look. When you go back, for example, back here, back in this 2007, 2009 period we were in, basically value was very cheap, growth was very expensive. What we saw is we've seen that come the other way. Now it's to a point now where we're starting to see that growth is cheap and value is a little more expensive, still discounted down quite a bit. Again, growth stocks are the ones that don't pay as many dividends. the company is putting a lot of the money back into the company to grow that company. You'll see the price earnings ratio is probably be a lot higher. So the price of the stock to the earnings of the company is going to be, basically, you're not going to have as much earnings. So that ratio is much higher. Same with the value. With value, the price earnings will probably be more in line with averages, or at least a lot closer. And they are usually more of a dividend payer. So what we're seeing is now we've seen the growth stocks become very discounted. Now, the question is, when do we trip the trigger and start getting into some of those growth stocks again? But that's the thing that we're looking at, where value has been outperforming growth for quite a while. Growth outperformed value, but now we've seen growth get cheaper, value more expensive in the last period of time. But those are things we're looking at as far as which equities we're going to be in. Now, one thing I did want to highlight here is the concept of the S&P 500. I want people to be cautious not to get too wrapped up in what's going on when you're looking at just the S&P 500. Because first of all, if you look at the top 10 stocks, their price to earnings ratio is currently at 22.9. You look at the remaining stocks, the other 400, the other, what would be 450, that basically you're looking at about 14.8. So bottom line to this is, when you're looking at this, when you have the Microsofts of the world, and I'll use them as an example, they're one of the top 10 capitalized stocks of the S&P 500. They run a PE ratio of around 24. There's a lot of other stocks that we look at that may be better buys. That's why you just don't buy everything in the S&P 500 all the time. You look at which stocks are going to provide you that ability. And there's other things we look at. So basically, when you look at it, the top 10 stocks have about 29% of the weight of the S&P 500. So 10 stocks out of 500, they have weighting of 30%. That's how much they influence the S&P 500. So just be cautious when we're looking at it. The bottom line to this slide is we see some decent buys from that standpoint. International equity, I just wanted to spend a second on this. We kind of forget about international. It's not been the place to be. The bottom line is what we're seeing with international. Our current PE ratio, when we're looking right now, is about 15.8. We're looking at some of the foreign markets, for example, Japan, 12.4, China, 10.1, Europe, 10.8, emerging markets on an average about 10.8. So I think what we can see is we can see some opportunity from a price to earnings ratio in some of these international. I mean, again, we don't bet here, but one of the things we are seeing is we are seeing a lot of people looking at, and we are looking at emerging markets because we're seeing some deep discounts. Now, don't see that going to dramatically go that way until we start seeing some interest rate changes. And also we need to see the dollar do some things. But when we're looking at it, that's what we are looking at. Current investment risks, the Fed could push the economy into recession if it over tightens too much. So if they just keep raising interest rates and raising interest rates, don't think that's going to happen past the end of this year too much, because we are starting to see some good signs. The whole Russia thing, I keep bringing that up. And markets may remain depressed and volatile until investors receive clarity on inflation and the Fed. Interest rates coming down and inflation coming down. Going to be hand in hand as you go forward. Some current investment themes, fixed income, I mentioned that. There's some opportunities there. Use profits as a guide. This is my whole PE ratio talk. What are the future earnings of a company? What are they going to provide? Bottom line is, if you want to get down to buying companies, it's what are they going to earn over a period of time? Falling dollar may support international equities as that plays out. So those are some themes that we're looking at. Bottom line, soaring inventories, not good. Flat retail sales, not good. Weak production data, not good. Weak consumer and small business sentiment, not good. Inverted yield curve, not good. Points to slow growth. But actually, all of these things are what we want to happen, because it means that we are closer to the bottom. Now, again, not going to go in. If you want to spend time going through this with me, we can. Just going to mention this quickly. There's some psychological market indicators that I look at. For example, the VIX gives me an idea of how much volatility we have. Now, actually, when these things hit certain limits, and I put these green, actually, we're seeing the volatility in the VIX. What it's done is it's actually showing me that we're getting closer to the bottom. So that's good. Put to call ratio, which is an options thing, again, telling me that we're getting closer to the bottom. A ratio I look at of bulls to bears, again, telling me all three of these indicators, way too technical for a day-to-day discussions. But when I look at this, it gives me an idea that we are getting closer to the bottom, which means the Fed will start lightening up. The ways to go yet. Now, one of the things I want to talk about is as we get into election season, again, I am agnostic as far as what goes on when it comes to politics, when it comes to your investing. But I do want to let you know that consumer sentiment or consumer confidence does vary by your thought process. My warning here is when you look at this chart, the red is Republican, the blue is Democrat. You know, for example, when you look at election day, depending on who's elected, the Republicans were much more confident when they were in office. The Democrats were more confident when they were in office. Right now, there's not a lot of confidence by both parties. The Democrats are a little more confident. But when you see this, what this tells me is don't let your political affiliation drive your investment decisions. Take that out of the picture. Because what happens is, as I always tell people, I have the Fox and I have the MSNBC people. Be cautious because both, and whether you're watching CNBC or Fox Business, be cautious because those people are just trying to sell ads. They're trying to create controversy. That's why we look at the numbers. So you determine, you know, how you feel about issues is up to you. We're looking at it from what's going to happen from now consumer sentiment does make a difference. I want everybody, both red and blue, to be positive. We must always balance very real emotion with cold logic. A market economy is to economics what democracy is to government. If a decent, if flawed choice among many bad alternatives. Again, our system isn't perfect. I mean, I think we have to be the first to admit that. But it has been a system for a long time that has really provided us the ability to balance between the different areas of government we have, between our three branches of government, between our checks and balances system. It's allowed us to seek some normality as far as addressing these problems. And the Fed being independent, which is very important, is a key to that. As we go forward, I just want to make sure that we control emotion. We're not a firm that says you don't do anything. We should be looking, and we are looking at each holding in each portfolio. As I mentioned, right now I'm looking at, I think between now and the end of the year, of ways that we can look at each holding. Is there some cash we can free up? If we're going to sit on the cash, do we look at treasuries? Those are the things that we're talking about. And plus, going back to that bucket theory, it's very important that we understand what your theory is on when you need money. So overall, in summary, the economy is very negative right now. No question about it. That's not a debate. I've showed you the numbers it is. The good news is kind of behind the scenes of those numbers, we are starting to see some thawing that the Fed is actually doing what we want them to do. The question is, how long before that works? How long before that does turn markets around? Nobody knows that question. The Fed doesn't know that question. I read the Fed minutes on an ongoing basis when they come out, and it's amazing. Very smart people, have been doing this a long time, very academic. But what happens is they don't have a real thorough idea either, because this is a living organism that has to play out over time. What our theory is right now, look at the holdings. Do we have solid things that will come back? If we need to make some adjustments, we make some adjustments. We got money in cash. How can we try to maximize that cash? What can we do? But the most important thing is back to that bucket idea. When do you need that money? If we need the money, then we need to have that available, especially that short, intermediate term, especially the short term. And we need to know your income types of theories. I'm going to take a glance here at questions quick. I know I'm past my half hour. I am worried about a true recession. One of the clients asked, possible nationwide job loss. Can this be avoided? It's a balancing act. I mean, we're probably going to see, when you look at employment, numbers are still very good. Our employment numbers are still very solid. We could drop a little bit and still be okay. So when you're looking at this, Yes, to answer the question, are we going to have a true recession? Again, 2 negative quarters of GDP? Could, yeah. I mean, there's a possibility. But I like the fact, and this is where I'm hanging my hat is, again, the numbers that I look at are much more detailed. I am seeing some thawing with that, but I don't see that tomorrow. So we still need to be very aware of what you're trying to do with your money to make sure. I do believe in a business cycle. The business cycle will work its way through, and we're seeing that happen, which is the good news. 401ks, somebody mentioned about looking at 401ks if you're retiring in a certain period of time. I tell people with their 401ks, make sure that you're monitoring those the same as we're monitoring everything else. We encourage you getting us statements of your 401k so we can look at it, because what happens then we can dovetail that with your current portfolio. And plus too, as you're getting closer to retirement, and again, there's a difference between saying I'm going to retire. That doesn't mean you're going to spend all your money tomorrow. You don't go into a shell and just do nothing unless you've met all your goals, and we don't want to take the risk. I've done that before. But overall, we usually stay invested to a degree. And that degree depends on what we need to do as far as cash flow and just how you feel. If you've met all your goals, you got more than enough money, you never have to worry again, then we look at something, heck, let's buy a 4% treasury and sit on it for the rest of your life. If they stay at those levels when they come due, but it's not going to give you growth that the market's going to give you over a period of time, but not a bad thing. I always tell people there's no absolute in any of this stuff that we're talking about. There is academic analysis and years of looking at this that we see where we want to be. I've got a few other questions falling into kind of the same mode. Worried about recession. Again, yes. I think there's a very high probability, but the numbers I'm seeing, like I say, the consumer confidence numbers, I'm glad to see them turning. I'm glad to see people are feeling a little bit better in certain instances. That varies from person to person, but we look at it as an overall. So that's mainly it for questions. Overall, I want to thank everybody for attending. Feel free to follow up with any questions you have. Give myself or any other advisors a call. We're more than happy to go through these numbers in detail. We are setting up a ton of reviews right now. Plus, too, we do have some very exciting announcements that Oaktree is looking at. Again, we're always thinking of the best way that we can service our clients, the best relationships we can have, the best resources we can provide. And we are looking at some opportunities there to enhance those that we think will be very, very exciting as we go forward. We're completely independent, so we can kind of evolve our system the way that we need to. And we're looking at ways to always enhance that. So thank you for your time. I know we're at about 40 minutes. I want to thank you for listening. And if you have any questions as we go forward, feel free to submit this. Thanks and have a great day.